Let's just dive right into this explainer, guys, because we have a massive financial puzzle to unpack hidden inside Lululemon's Q1 2026 SEC Form 10Q filing. Now, usually, when a company files a 10Q with the SEC, it's pretty much a guaranteed cure for insomnia, right? But this quarter, oh man, it reads less like a boring accounting update and way more like a straight-up financial mystery waiting to be solved. I mean, we all know the logo. It's literally everywhere. Gyms, coffee shops, your office. But today, we're zooming way past the premium athleisure wear to look at the raw, under-the-hood business mechanics of a global giant, right in the middle of a massive transitional phase. We're going to see exactly what happens when surging sales slam right into shrinking margins. And hey, don't sweat the 40-plus pages of dense accounting jargon and tables in the original filing, because this explainer is going to be your straightforward roadmap. So, here's our roadmap for today. We'll hit the Q1 2026 paradox, break down the revenue, piece together the profitability puzzle, check out their cash and buybacks, and finally look at future leadership. All right, starting with Section 1, the Q1 2026 paradox, where top-line growth meets bottom-line reality. Let's kick things off with the central mystery of the quarter, which sets up a massive, glaring contradiction right on their income statement. Lululemon pulled in a staggering $2.47 billion in net revenue for Q1. That's billion with a B. And honestly, it's a super solid bump from the $2.37 billion they did in the exact same quarter last year. By all normal top-line metrics, they're killing it, successfully selling more products and bringing more cash through the door. But wait, here is the paradox. Despite that huge top-line revenue growth, their bottom-line net income absolutely tanked. Last year, Q1 net income was sitting comfortably at $314.5 million. But this year, it plummeted down to just $195 million. That is a brutal drop in actual profit. I mean, it's a textbook corporate paradox. How do you make over $100 million more in revenue, but end up with over $100 million less in profit? Honestly, it's a perfect example of why just looking at top-line growth can be a massive trap for potential investors. Moving to Section 2, breaking down the revenue to see exactly where that money is coming from. To solve this puzzle, we first got to figure out how they even hit that $2.47 billion mark in the first place. We need to know what's flying off the shelves and where. Well, women's apparel is still the undisputed heavyweight champion of their product line. It brought in an incredible $1.6 billion all on its own. That vastly outpaces men's apparel at around $581 million and accessories at roughly $286 million. This is a huge deal because it proves their core demographic remains incredibly loyal, driving the vast majority of their sales volume and giving them a highly reliable foundation. Now, if we look at their geographic footprint, we uncover a truly fascinating trend. The Americas are still the biggest slice of the overall pie, generating over $1.6 billion. But look at the People's Republic of China. They saw an absolutely incredible surge. Sales over there jumped from $412 million in Q1 last year to nearly $530 million this quarter. That is aggressive, targeted growth in a highly competitive international market. It really signals exactly where Lululemon's future expansion strategy is laser-focused. Also, analyzing their sales channels shows us that their 816 physical company-operated stores are actually edging out their direct-to-consumer e-commerce sales. We're talking $1.19 billion generated in-store versus $997 million online. It just goes to show that brick-and-mortar is still a highly lucrative and essential foundation for the brand experience. For their shoppers, that in-person touchpoint is definitely still king. Okay. On to Section 3, the profitability puzzle, where we try to solve this margin mystery. So, how does all this help us solve our core financial contradiction? We know they're selling way more, especially in China, and women's apparel is totally driving the bus. But what is going wrong on the balance sheet? We have to ask the multi-million-dollar question here. If revenue is up, where exactly did all that money go? To figure that out, we have to look at what it actually costs to run the Lululemon machine. Well, the culprits are hiding right there in their consolidated statements of operations. Both the cost of goods sold and their SG&A, which is selling general and administrative expenses, spiked massively compared to 2025. The literal cost to make their products jumped from roughly $987 million to $1.13 billion. And meanwhile, SG&A, which includes everything from store leases to corporate salaries and marketing, shot up from $942 million to over $1.05 billion. These twin spikes in operational costs just entirely swallowed their revenue gains, crushing their net income for the quarter. It's a critical takeaway for anyone analyzing the retail sector right now. aggressive growth is becoming significantly more expensive to maintain. Which brings us to Section 4, cash, inventory, and buybacks. Let's evaluate their war chest. Even with these rising expenses squeezing their margins, we have to take a step back and evaluate the overall health of their corporate war chest. Are they in actual trouble, or do they have a safety net? Honestly, it's pretty clear Lululemon is still dealing from a position of massive financial strength. Yes, holding $1.68 billion tied up in physical inventory is a hefty commitment of resources, but they are comfortably sitting on $1.51 billion in cash and cash equivalents. And more impressively, the board has authorized an incredibly aggressive stock repurchase program, allowing the company to buy back up to $4 billion of its own stock. In fact, in just this single quarter alone, they repurchased 2.2 million shares of their own common stock at a total cost of over $361.8 million. This brilliant move really illustrates management's confidence. They are effectively taking money out of their corporate savings account to invest right back into the house. It sends a clear signal to the market that they believe their own stock is currently the best possible investment they can make. Finally, let's look at Section 5, Leadership and the Future, Navigating a Transitional Era. Because at the end of the day, numbers on a spreadsheet only ever tell part of the story. Who is steering the ship is just as important as the cargo it carries, right? And we are looking at a highly significant structural shift at the very top of the company. Their former CEO stepped down at the end of January 2026. That means these Q1 financials we've just analyzed were achieved during a deeply transitional period where interim co-CEOs, specifically the CFO and the president, were bridging the leadership gap. They've been keeping this massive engine running while waiting for a brand new chief executive to officially arrive in September of 2026. So, as we wrap up this explainer, I want to leave you with a final, provocative thought to consider. Are these shrinking profits we saw a sign of impending brand fatigue? Or is this simply temporary turbulence as Lululemon deliberately funds its massive global expansion, particularly in places like China, and lays the expensive groundwork for its next major chapter under brand new leadership? The foundation is clearly strong, but man, those margins are tightening. Thank you so much for joining me to unpack the real story inside the numbers.